ለመማር ወደ ትምህርት ተቋም መሄድ ግድ አይደለም።
ናሽናል አቪዬሽን ኮሌጅ
ራሳችሁን ከኮሮና ቫይረስ ወረርሽኝ እየጠበቃችሁ በቤታችሁ ወይም በተመቻችሁ ቦታ
በኢንተርኔት አማካኝነት በኦንላይን ትምህርታችሁን መከታተል ይቻላል።
ካናዳ ከሚገኘው ኢንተርናሽናል ኤር ትራንስፖርት አሶሲዬሽን አያታና
ከእንግሊዙ ኢንስቲትዩት ኦፍ ኮመርሻል ማኔጅመንት ICM ጋር በመተባበር የሚሰጡ ትምህርቶችን ተከታትላችሁ በ6 ወር ጊዜ በዓለም አቀፍ ደረጃ ተቀባይነት ያለውን የስልጠና ማስረጃ ባለቤት መሆን ይቻላል።
ከኢትዮጵያ ሲቪል አቪዬሽን ባለስልጣን ሙሉ ዕውቅና ባገኘንባቸው የፍላይት ኦፕሬሽን እና የሆስተስ ስልጠናም በምዝገባ ላይ ነን።
ጥያቄና መልስ፣ የክፍል ስራዎች ብሎም ፈተና መፈተን ክፍል ውስጥ እንዳላችሁ አይነት
ልምድ ባላቸው መምህራን እየተማራችሁ
በኦንላይን ባላችሁበት ቦታ
አድራሻ ከ22 ማዞሪያ ወደ ሾላ ገበያ በሚወስደው መንገድ 150 ሜትር ገባ ብሎ ናሽናል አቪዬሽን ኮሌጅ
የናሽናል ኤርዌይስ እህት ኩባንያ
ህልሞን እውን ያደርጋል።
Now, I last time I discussed about the financial statement analysis and interpretation, and just as I had promised earlier on in the first class, that I'm going to come up with a course outline which will indicate the areas for each one of you to go through and do research and come and present. And the time for presentation will come later. But I just wanted to take time to introduce you to the concept of financial statement analysis and investment analysis, management, portfolio management. So I had actually started by introducing the financial statement analysis. So I looked at the importance and why we look at financial statement analysis, why ratios are so handy in terms of if you want to evaluate the performance of a given organization. All right. And again, we said that financial statements are there for the users to make use of them to make decisions about the organization. Could be when they want to invest in the organization, could be the shareholders who may be interested in the returns from the organization because they have invested in the organization. There could be debtors, creditors who may be interested in the ability of the organization to repay their credit facility that they have given to the organization. And we grouped the ratios into 5 main categories. We had the profitability ratios, because there are those users who may be interested in the profitability of the organization. So them, they will go for profitability ratios. And then we have the liquidity ratios. There are those parties who may be interested in the liquidity levels of the organization, like the creditors, because they will want to know if the advanced credit facility to this organization, will they be in position to pay back whatever they have offered them or whatever they have given them. So those may be interested in the liquidity ratios. So there are a number of ratios that we compute under liquidity ratios. And I went through that. We went through that last time just to show which ratios that can be computed under liquidity ratios and how. All right, given the formula, because we have to have the formula that we need to use to determine a particular ratio, so that we can now utilize that ratio to make a decision about the organization. Then we have the gearing ratios or leverage ratios. These are the ratios that explain the composition of the capital structure in terms of the debt capital and the equity capital. So in a situation where we have more of debt capital, then we say the company is highly geared, which means it has more of debt than equity capital. And of course, in practical sense, it has a lot of signal effect on that, because it means the company is being exposed to financial risk. If it means that the company is actually in the hands of the creditors, right? When it's supposed to be in the hands of the owners. So that's why, as managers, we have to be keen about the levels of our debt to equity capital composition in our capital structure. So that's why in the area of finance, we always concerned about the capital structure of the organization. And as managers, we are the ones responsible to make such decisions. So ratios help us come up with the right decisions with regard to the capital structure, with regard to the sources of funds, and where to source the funds at any given time, so that we ensure that we are complying with our capital structure principles. Now, the other also ratios that we could talk of, other than liquidity, we have leverage, which is also gearing. We have profitability. We also have activity ratios. And activity ratios are basically looking at the working capital activities, because working capital is a composition of the debt, the current assets and current liabilities. So when we have an analysis of the debt capital, the current assets and current liabilities, where we are analyzing our operational activities. So our operational activities help us to determine how able are we organization when they fall due. Are we able to pay our creditors when the right time comes, when the time comes for us to pay them? All right. Are we able to collect our debtors in good time, so that they are able to provide us funds so that we are able to pay our creditors? All right. So those are some of the questions that we need to ask ourselves as managers. But as much as we do that, then we come up with the policies that guide the operation of the organization. Policies to do with probably the credit period. How many days do we give our debtors to pay us? All right. If you are looking for credit facility, how many days can we be allowed to pay our creditors? Those are some of the questions we ask ourselves as managers, as much as we have to make this kind of decisions. But then, other than that, we have to have a basis for making these decisions. And this is where now the financial statements come in handy. And using the financial statement figures, we are able to compute figures or ratios that will be able to help us make informed decision, probably on policy that we come up with in terms of the credit policy that we are giving our debtors, in terms of the period that we may go to negotiate with our creditors so that they can allow us, all right, and many other operational activities, as you may understand, that require a day-to-day analysis and commitment, so that if you need cash at any given time to purchase or to pay your rent, will that cash be available at that particular time? So these are the questions that we ask ourselves, and then now we have to have a tool that will help us get there. And this tool is precisely what you're talking about, the ratios. So ratios are very important when it comes to analyzing the financial statements. We have also the fifth one, which is the shareholders ratios, or they're called earnings ratios, because they're basically the key interest is about the returns. What are we getting as investors in this organization? So the shareholders are people who own the organization, and they have a key interest in the organization as investors in that organization. So what are some of the ratios that they can compute to help them um, uh, say more or tell more about the organization they have invested in terms of dividends, right? What do they expect in terms of dividends? What's the dividend ratio? What's the dividend payout ratio? What's the earnings yield? What is the PE ratio? No, there are those kind of ratios that we may compute, that all shareholders may compute, so that they make decision about the organization, or they can be informed about the organization's status at any given time. So this is very important. And just as much as we are managers and we are bound to make decisions about financial, the financial capabilities of the organization in terms of are they able to meet their day-to-day obligations? Are they able to pay dividends when they declare? Are they able to invest in to expand in terms of investing in the right investment projects? So these are some of the decisions that we have to make. But again, we realize that we need to utilize the ratios as a basis of helping us make informed decisions. So with that, I think there is always a complementary purpose between ratio analysis and the investment decisions. If you have to invest, all right, then you have to make the right decision. And when you are analyzing projects, just like we looked at our previous semester corporate finance, we have those decisions that you have to make. And we were analyzing projects. We were looking at the cash flows. We were looking at the expected outflows and inflows and the returns and all this. All this information can be gotten from the financial statement. So that's why we need to appreciate financial statements from the word go, because they are the ones that give us the necessary information, which when we identify the right tool, we are able to make informed decisions about the organization. So that is the basis of that. And then now I was to run you through an illustration which would help us understand, just appreciate the financial statements, all right, and the ratios that we may compute and how we compute such ratios. So the kind of illustration I had intended we look at cuts across the number of the types of ratios that we have discussed, the 5 of them, right? So you'd compute from each of them, and then now you see the kind of decisions that you're making. As for example, if you get a ratio for company A is this, and a ratio for company B is this, then where is the connection point, and where is the decision to be made? All right. Then again, we said ratios help us in terms of comparison. We are able to compare different organizations, all right, at different times, all right, or different organization at the same time or same period, but same organization but at different times. we're able to compare the performance, and then probably we'll be able to establish whether there's an increase in the performance or a decrease in the performance over a period of time. So this is why we need to appreciate ratios. Again, we can do it just for our own decision-making purposes. So there are so many advantages, and I'd outlined a number of advantages in my last slides, just to appreciate the ratios as a tool of analysis. Now, before we continue, let me just ask: were you able to access the slides that I was using last time on Saturday?
The slides? Which
Yes.
slides?
Okay. I think when I'm presenting the recording, and when you open the link, you'll always see the slides scrolling.
Oh, okay.
I don't know whether you've been able to do that, because I was told just to continue, and the recording is taking place so that you guys can access at your own free time.
Okay.
Otherwise, if that is not possible for you, I'll be able to share whatever I discussed last time.
So it's better to share. It's better to share us through emails.
All right. So I'll
continue through illustration, then share your slides.
So what I'll do, I may not send to each and everybody,
yes.
But Girma, you know the members of the class, so we'll do like we did last time. I send to you, and then you share to the rest.
Okay.
Is that okay?
That's okay.
All right.
I can do that.
Okay, so we have like around 30 minutes, but let's see. Let's run through the illustration and see what we can get out of that. If you are acceptable to that.
Okay.
Are you acceptable to that, Melat?
Yeah, I accept. We accept. Melat?
Yes. Yes.
Illustration in general, yeah, no? Some
Okay,
illustration.
So let me just share the screen. Give me a few minutes. I do that.
Okay.
About that?
Yes. Ratio analysis.
Ratio analysis and interpretation of financial statements, right? Okay, so so this is a typical question where we need to compute some ratios. We've been given the financial statements. Where we are coming in at the point where we've been given the statements. We are not required to prepare the statements, but you are given the statements. And then now, using these statements, are we able to compute the right ratios and make informed decisions, all right, about the organizations that we are talking about, or about the same organization but different periods we are talking about, all right? So I will start with the illustration 1. The balance sheet of ABC Limited as at 1st December 2018 and 2019 were as follows. So this is the same organization, and we said if it's the same organization, then we call it trend analysis. So we are bound to do trend analysis. If it is two different organizations, then we are bound to do cross-sectional analysis. Cross-sectional analysis. All right.
Okay.
So take note of that. Those are two different approaches. One is trend, and another one is cross-sectional. So within the same organization, that is cross-sectional. That is trend.
Trend analysis. Yes.
We have two different years. All right. The one for 2018 and 2019. So you've been given two statements. Okay. So we have been given the items like tangible assets. We have cost of valuation and all that, all this. Then current assets, we have current liabilities, we have current net current assets, we have loans, all right? We have called up share capital, share premium, revaluation reserve, profit and loss, right, account. Then stock as at 31st, this is supposed to be 31st December 2018 was this. I think 2018, yes. 2018, not 2017. I think, yeah, this is supposed to be 2018. No, this is right. This is 2017 because
end of the ending balance.
It is the
beginning of opening balance. Yes.
Yes. So this is correct. So the summarized profit and loss account for the year is this. All right. So had I sent you this?
No, you can't send.
No.
Possible to send
I had not sent you. Oh, okay.
Yeah. Nothing
sent
to me. No, you don't send.
Okay. All right. So anyway, but you're following. I can share after that, but you're following. Okay. So you have gross profit, your sales, gross profit, and then expenses. These are the total expenses. The net profit before tax is this. So you are required to calculate the following accounting ratios for both years and compare the results. So you need to compare results for year 1, assuming 2018 is year 1 and 2019 is year 2. All right. So the gross profit percentage, So you need to know the ratio.
Income statement. Okay.
Yeah.
The formula. All right. What do you think is the formula to determine the gross profit percentage?
Gross profit percentage you can get from the income statement.
Yeah.
You get from the income statement, yes.
Statement, yes.
But what's the formula first?
Cost of goods sold.
Sales over cost of goods sold.
Cost of goods sold over sales.
I can also share the last slide so that
I think it is sales over cost of goods sold. Sales over or divide by cost of goods sold. Total sales?
No.
Not? Am I not correct?
You said what?
Sales over
sales
or divide by cost of goods sold. Percentage of
cost of goods sold over sales.
Cost of goods sold over sales.
Yeah.
No, gross profit means that total sales minus cost of goods sold. You come to gross profit. That gross profit divided by sales can get the profit contribution of sales. Sales contribution from the profit. Am I right? Hello, doctor.
Yes.
When it come to cross,
Let me just
gross profit in sense that sales deduct
Minus
cost of goods sold
cost of
come cross the gross profit.
Yeah.
Then this gross profit divided by sales, we know the contribution of sales from the total profit, the gross profit.
I think for profit, for what are we being asked for?
The question is the gross profit percentage.
The gross profit percentage. So when you ask the gross profit percentage, then you are you seeing the analysis, whatever we discussed last time? Classification of ratios, yeah. Are you seeing there?
We have seen, but not we don't have the slide.
Oh, you are not seeing the slide. You cannot read the slide.
Yeah.
We are not received. Yes, we cannot refer it again.
New share.
Better to share us.
Can you read that?
Yes, current ratio, cash ratio, gross profit ratio, gross profit.
Profitability ratios.
Over sales. Okay.
So gross profit margin is actually the gross profit ratio.
Yes. Gross profit per sales.
Yeah.
So it is gross profit over
sales.
Sales times 100. Okay. So gross profit over sales times
100.
So from for 2018, what is our gross profit? What was our gross profit according to the first slide?
24,000.
24,000.
Sales 64,000. Hello? Sales 64,000. Per
Over sales
over
64,000 or 640.
I think 64.
Why is that? New share.
Okay.
Our sales is 64,000. Yes.
Yeah.
Of course, we have 3 zeros up there, but we ignore that. All right. So this these figures are expressed in Kenya shillings. Sorry for that.
Shilling, yeah.
I should have changed them into dollars. But anyway, I hope you understand. The important thing is getting the right figures.
Okay.
So sales figure is
Sales figure is 64,000. Yes.
Okay, 64,000.
Yeah.
Times 100.
100.
So this gives us what? What's the percentage of that?
Percentage of that.
That is 24 over 64 times 100. Are you getting 37.5?
Yeah. Yeah, 37.5.
0.5%.
7.5%, yes.
Okay. This is 2018. How about 2019? 2019.
Okay.
what is the
Okay.
ratios? What are the figures that we need to use?
The figure, can we cross there? Come back
So
to
this is 2019
and 18 and 75. Okay.
108 and
32,400.
75. No,
32. No,
32 400.
32,400.
Okay, so we go back. So is 32? No,
32. Oh, yes.
32. Yes, 32.
32 400.
32,400.
400.
that is the gross profit.
Yes.
That's the gross profit. Yes.
Okay.
400.
Over
Divided by
108,000.
108,000.
Yeah.
Like that
Yeah.
times 100.
100.
So that will give you. Work out that
30%. 30%. 30%.
30%.
Yeah.
30.
Okay, 30%. So what can you say about our gross profit percentage for 2018 and 2019? Is there an improvement or there is a decrease in our profit?
There is a decrease.
Decrease.
There's a decrease, isn't it?
Yeah.
So
Yes.
you see, when you look at this figure, you had 24 gross profit, 24,000,
Yeah.
and you had 32,000.
Yes.
But you see, when you compare those figures with the sales, you realize that you are decreasing. But if you just look at the gross profit, you would say our gross profit has increased. Are you seeing the difference?
Yes, I have seen that.
Yes.
It had increased from 2014, all right,
To
from
32.
24 to 32, isn't it?
32.
Yes.
However,
But in the real sense, when it
There
comes
is
to
sales.
real analysis, you realize that we are not doing well, isn't it?
Yeah.
We are not doing well because despite the fact that our gross profit has increased, when you compute a ratio, it tells you something different, isn't it? So
Yeah.
that's why we prefer ratios other than just looking at figures the way they are. Are you seeing now? Yes. Because this can be, when we just look at the figures, that this can be misleading, all right?
Yes.
But when you compare with the sales figure, then you realize that we are doing badly, all right? We are moving from 37% to 30%. Okay? So
Yes.
this is the power of the ratio, and that's why we use ratios in our analysis as organization. So as a manager, what do you think that you need to do to improve on our ratio so that we don't drop from 37 to 30, but instead we should be increasing from 37 to 40? What do you think we can do to do that, to improve on that?
To reduce cost of goods sold?
Yes. Try to minimize the cost, isn't it? The cost of goods sold, yes, because it means we are incurring more costs than even the sales we are making, because the costs are eating into our sales. All right.
Yeah.
So, what is the other option?
The other option, decrease the sales volume.
Okay, increase the sales volume, because when you increase the sales volume, then you absorb more of these costs, isn't it?
No.
Which is the other option? Of course, if you are to increase the sales volume, then it means probably you need to check your pricing, isn't it?
Yeah. Yeah.
Yes. So when you increase your price, it means you are limiting your demand, isn't it? But when you
Yes.
decrease your price, it means you are increasing.
Demand for, okay.
If you decrease your price, you are increasing your demand, isn't it? So you need to
Yes.
play around with that. If your objective, because as a manager, you know, before you make a decision, you must have a set objective, isn't it? For making that decision. So, which is your objective? If your objective is to increase the volume of sales, then you need to check your pricing, isn't it? So that
Yes.
you can play around with your pricing, but of course, prices must cover the costs that you're incurring. So the issue is playing around with your profitability margin. What is your margin? What margin can you play around with? So this is why when you go to now the management accounting aspect, where you have the CVP analysis, cost volume profit analysis, that's when now you also need to apply that tool to help you come up with the right pricing that you need to give or to offer your goods at, so that you achieve some of these objectives that you may have set. Okay, so it is always a combination of a variety of tools that you use. A good manager will not always not just use one tool, all right, or one, like when you compute this, then you finalize that this is it. No, you have to compute at least three or apply at least three models so that you see which one are they giving you the same indications. So if they are giving you the same indications, then you are justified to conclude and make a decision accordingly. But one can be wrong because of the other. Some variables may have not been well reflected, but always it's advisable that we compute at least three or at least two models or two indicators. And if they're giving you the same direction, then you can easily conclude and base your decision on that. So this is, I just wanted us to appreciate why we use ratios other than looking at the absolute figures, because you may look at gross profit to be 2019, you reported 32,000. In 2018, you reported 24,000, but you realize that you performed well in 2018 than in 2019, despite the fact that you reported a higher gross profit. Any question on that? Okay, so we can go to the next one. So we're being asked to compute the current ratio and the quick ratio. So starting with the current ratio, all right. First of all, we need to understand the formula for determining that. And what is the formula?
Current asset
Now
over
back
current
to
liability.
yes. So that is under liquidity ratios.
Yes,
I hope we are
ratio.
together. Liquidity ratios. All right. Current ratio we can see is current assets over current liability. And then we are also asked to compute this one. So which is current assets
Current
minus
assets, inventory.
Minus
Over current
inventories
liability.
over current liabilities. So take note of these formulas because they're the ones we're going to use in computing the part B of the question. So back to, all right, the question. So okay, I need to show this. So allow me to erase this. So current ratio is equals to current assets
over current limit.
over current liabilities. So CA stands for current assets, CL stands for current liabilities. And now come to 2018. 2018. What is our total current assets? Okay, so you go to the statements and look for our total current assets.
From balance sheet, yes.
Yes, you go to the balance sheet, that's where you get them. For 2018, what is our total current assets?
Total current assets. Stock, debtors, no cash. 23,900.
23,900. Okay, and current liabilities?
14,100.
4,200.
14,000.
200. I mean,
That's
yeah,
200.
yes.
Okay, so we take those figures. Um, 23,900 divide by 40, 200. So this would give us what?
1.68. 1.68.
1.68.
8.
That correct?
Yes.
Okay. Can you give me for 2019? For 2019?
Okay.
Get the figures. Okay, the figures for 2019 are, we have current assets, how much?
Yes, 31,000.
31,000, right?
Over?
Over
20,400.
2,400. Okay.
Okay, 51.
At 1,000.
31,000
over
20,400.
That would give us what?
1.52.
1.52.
2.
Okay, now my question is, after computing these ratios for 2018 and we have 2019, so are we doing better or we are doing worse? Comparing the two.
We are doing worse. The first one is better. 1.65.
The first one,
It's better.
28 is better. Why?
Better.
Why?
Because we have a lot of assets to cover the liabilities.
Yes. So this ratio indicates us how much assets we have in current, isn't it? The current, not total assets, current. How much current assets we have to cover our liabilities, our current liabilities. So the higher the ratio, the better for the firm, because it means we are able to pay our liabilities when they fall due in good time. Right? Which is good. Which is good for the organization. So just the same thinking, just like the one I was just giving you earlier on. You can see in 2018, we had 23,000 in terms of assets. And in 2019, we had 31,000 in terms of assets. And yet we are doing badly in 2019 than in 2018. So that you need now to look at now the liabilities. Again, it's also important that we compare this, like this ratio. We have standards. Like a good standard is when we can have 2 to 1. 2 to 1.
2 to 1.
2 to 1.
Two assets. One liability.
So that the assets are supposed to cover the liabilities at least twice.
Okay.
So when it is 1.68, we are closer to 2, isn't it? So
Yes.
1.68 represents the 2.
Okay.
So we are closer to 2 than 1.52, isn't it?
Yes.
Because this is actually to 1.
Uh-huh. Yeah.
That's the meaning of that. All right.
Okay.
So when you have this, the standard ratio is 2 to 1. All right. We need to have our liabilities being covered at least twice by the assets, the current assets that we have in our books at a given balance sheet date. Okay. So as much as you compare the 2 years, or if there are 2 different organizations, as much as you're comparing the 2 different organizations, it's always important that you also compare with the standard ratio, which is normally allowable, depending on the industry, because there are different industries. This organization belongs to different industries. But generally, in our analysis, we normally use 2 to 1 as a measure, right? Okay. Performance in terms of current assets and current liabilities. Then we have the quick asset ratio, right? It's just modifying this one, all right, so that I can erase this so that I call it quick asset ratio. Quick. Quick. Is it called quick ratio?
Quick ratio or acidic test ratio.
Or acid test ratio. Good.
Yeah.
Minus
Inventory.
minus stock or inventories. Minus inventories. Inventories are the same as stock. You know, some books call it inventories, others call it stock, depending on the author's origin, where the Briton called it stock, the Americans call it inventories, all right? But they are referring to this one and the same thing. So we need to get for 2018. So the current assets, the current liabilities remain the same. It's only the top figure that will change, right?
Yeah.
So we go back to the question so that we get the
Statement.
get the figures. Huh? So can you give me the figures for
Inventory
our
stock
acid test ratio?
1,000, 12,000. 18.
Okay.
2018, 12,000. Whereas 2019, 50,000.
So it's what minus what?
23.
26,900.
23,900.
900 minus 12,000.
Okay. 23,900
minus
12,000.
12,000.
12,900.
That's for 2018. And then 2019, it's 31,
1,000,
1,000 minus
15,000.
15,000.
Yeah.
Okay. So going back to our whiteboard. So it is 23,
Yeah.
900. I hope you are able to read my writing.
Yeah.
Yes.
Okay, minus 12,000. And then here is 31,000 minus 15,000. So what does this one give you when you work it out? This minus this?
11,900.
11,000?
11,900.
Huh?
When you subtract this from this?
Yeah,
Yeah.
Or you give me
11,900.
the 11,000?
The ratio? Okay, 11,900.
900 over
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 4,200.
40,200
so this would give you
is equal to 0.83.
0.83.
Yeah.
0.83. Okay, and then here
Yeah.
this is
60,000.
16,
60,000. Yeah, 16.
16,000
Over
over
Over 20,400.
so this would give you
It's give you 0.78.
0.78.
78.
Now now you can see now the figures the way they are behaving. Okay. What is our quick ratio, our acid test ratio? When you compare for 2018 and for 2019, are we doing better or we are doing worse?
Now we have also doing worse.
We're doing worse.
Yeah.
And in the other scenario, the first case, we are doing better for 2018 or we are doing worse for 2018?
2018 we have make better.
When you go back to your current ratio,
The first case, similar. We are doing better in the first case.
we are doing better in the first case.
Yeah.
According to our current ratio.
Yeah. Yeah.
Right? So still
Quick
here we're
ratio
doing
also
better.
similar.
Okay. So you can see if you can compute and there's consistency in your results, then you can easily conclude that we are doing better. Other than just, you may be having a lot of stock that is actually adding up much of our current assets than the liabilities. But you see now the process of converting stock into sales is a long process, isn't it? Because you have to advertise probably, and you are not sure of the people who are going to buy your product. Those are some of the logistical issues that you need to consider even before you make a decision. That's why I said from the word go that you need to compute at least three ratios, and if they give you the same indication, then it means that's the right position you can go or you can take. So if you realize that now the current assets was giving us that 2018 we are doing better, and then you test again for quick ratio, you find it's also giving us the same as 2019 or 2018, then you can say we are doing better. And if you are a person to make a decision about the liquidity of the organization, then you would say the organization is in good liquidity or in bad liquidity state. Any question?
No question.
Okay. Our time is almost up. I don't know. Do we carry on? Unless you assure me, because there are many issues or factors to be considered here. Issues of security, issues of connection. All right. Are you? Me, I'm secured wherever I am. I'm okay. How about you?
It's better to continue tomorrow.
So we continue tomorrow.
Yeah.
So we've let me just share the question first so that we know which one we
Question
are.
first, and there's a slide also. Better to share us or to
Yes.
send to me.
Yeah. So we've done the current ratio and the quick ratio or acid test ratio, because according to the slide it gave us that. But then now we have the data collection period in days. C, D, E. We'll start with that tomorrow when we meet, so that we also get to understand where we are. So I'll share the this handout probably tomorrow before your class. Okay, so that when we are catching up, we have everything at hand for us to follow. For now, I will stop the sharing so that if there are any questions or comments. But as I told you earlier on, there are areas I will want you to go research on and which you will come back and do a presentation on. So I'll be sharing the course outline, indicating indicating the whoever is supposed to be presenting on which topic, isn't it? And again, apart from that, I will also share a summary of the areas that you need to concentrate on if you are handling, for example, a particular topic. Which areas are you supposed to consider as you are addressing that particular area, so that we remain relevant, so that we don't just get stuff that is not adding value to the subject matter of our discussion. Okay. Irma, are you there?
Yes, I'm there. Yeah.
Okay, fine. So with that note, I just want to call off the class, and thanks for joining. Where are the other members? They are not able to join?
We are able to call for them, but the phone is ringing. The phone is ringing. No answer.
There?
No answer. We can't. We are trying to call them.
Or you try to call them and they are not answering?
But yeah.
Okay.
So better to send us notes. And
yeah, but I hope they are still with us.
Yeah.
Are they still with us?
Yes.
Yes.
Okay, good. So I think I'll give you a task to reach out on them. Irma.
Yes.
When I'm sharing this, I'll give you a task to reach out on them, so that we see how we can move together. You know, some of these things is good when you are participating. Like what just the two questions you have handled, you can see where you need to get the right figures and where you need to include in your formula for you to get the right ratio that can help.
So we can. Okay. It's better. So
okay. Good night. I want to wish you good night and see you tomorrow at 2.
Thanks.
Right?
Thank you.
Bye bye.
Bye bye.
Bye bye.
Bye bye. Bye bye.